Hey everybody, Marty Mazzora here. This is your weekly economic update. Clients, you'll receive this on Monday, April 10th. This is for the week, of course, ending the 7th. And I'm going to do the usual. We'll look at our index, we'll look at some inputs, then we'll touch on the stock market and mix in a couple other sentiment indicators that I think are worthy of our attention at the moment. In front of you is our PWA index, and we actually dropped a pretty good chunk. In fact, we now sit at the lows of this cycle, we'll call it, literally right at a tie with early January of this year. And that's a negative 36 with only 18% of our positions now scoring positive, down 4% on the week, 53% scoring negative, up 4% on the week, 29% in the neutral columns. This strongly suggests that recession is on the not too distant horizon, which pretty much I'm certain is the consensus as we sit here today. Looking at the handful of inputs that I selected for you, we're going to start with the consumer savings ratio. And of course, it went to the sky during COVID, in very, very noisy sense, and then pretty much dropped to the floor. And this was a sign here that consumers were obviously saving at a slower clip and clearly spending some of that savings. And now you can see we've jumped nicely off that just multi-year low here, back up to 4.6%. So, at first blush, you might say, well, that's a good thing. Consumers are now saving more of their income. Economically speaking, we can surmise that it means less consumer spending. From a signal standpoint, I wanted to point you back here historically. We go back to the 70s and notice what came after pretty big spikes in consumer savings, and that were these red shaded areas, which are economic recessions. You see it there. You see it right at the beginning of that recession. You see the spike before that early 90s recession. You see it spike up right here before the tech bubble bursting recession. You see it spiking up right in here, just ahead of and during the great financial crisis, of course, the COVID recession. And here we are now. So that obviously comports with our overall view on what is to come. Initial jobless claims, we've gone through a multi-year revision, and the net result was notably higher, 228, and again, same thing, and I've done this with you a bunch of times. We can say things, and you hear people say things like, hey, this economy is in really good shape, just look at the labor market. Okay, but the minute the labor market begins to show strains, or very shortly thereafter historically, we tend to find ourselves in recession, right? So again, also is consistent with how we see the world currently. Continuing claims, as you can see, are rising at a concerning enough clip right in here. And again, you can do the same sort of observation right here with continuing claims as well. So this is a red flag as it relates to the state of the economy for sure. However, when we look at the jobs picture overall, still looks okay, right? We have 236,000 jobs created. It's definitely off of the 300 and something from the previous month. Unemployment rate actually ticked down from 3.6 to 3.5, rise in the labor force participation rate. So people perhaps coming back into the workforce and looking for jobs would actually raise that number. The U6 unemployment rate, which includes discouraged workers, part-time workers who want to work more hours and so on, that actually dropped from 6.8 to 6.7. The quits rate actually went up from 2.5 to 2.6. That's actually bullish. Folks don't tend to quit their jobs unless they have something better in the offing. Job openings, however, did tick down, but we're still pushing 10 million. So again, historically, that's a lot, but the trend is lower. So we'll keep an open mind and we'll stay on our toes. But right now, there's nothing that's really deterring us or having us with any less conviction on our recession outlook. We think that it is highly likely in the months to come. The Economic Surprise Index still scores positive for the U.S., but I just wanted to point out that it seems to be rolling over quite a bit. And recall that this is just Actual results relative to economists' expectations doesn't mean we're in expansion, doesn't mean we're in recession. It just measures the degree to which actual results conflict with what economists had expected. So typically what happens is, as economists are surprised to the upside, they ratchet up their expectations and then they get kind of caught to the downside. But definitely something to keep an eye on. It's a pretty precipitous drop here of late. The last three have to do with just market signals. This one's an important one, and I've been featuring this a lot lately because while tech continues to bounce and outperform the S&P 500, although 3 of the 4 trading days last week, tech suffered pretty good, so it came off the boil. The rest of the growthy or cyclical sectors are really underperforming. Financials pretty dramatically, and we know the issues in the financial sector are going to be very interesting in the coming week as bank earnings start coming out for the first quarter. Remember, below 100 means over the last 30 days anyway, it's that it's underperforming the S&P, as is consumer discretionary stocks, as are material stocks, as are energy stocks, and as are industrial stocks, quite notably. So again, economically sensitive sectors, these in particular, really underperforming the S&P 500. Now, economically defensive sectors that tend to do better during recessions, and that would be staples, utilities, and healthcare. Notice all of them are at 100 or above, which means they are now outperforming the S&P 500. So my point is, when the economically sensitive sectors are underperforming the broader average and the defensive sectors are outperforming, that's not a good sign. That would be a big red flag for the current state of the economy, or at least what the market is discounting with regard to the state of the economy. Same can be said for the stock-bond ratio. We use the S&P 500 and we use the long-term Treasury ETF. So when this is negative, and this is just a year-to-date look, stocks are underperforming the bond market. And as you can see, they're underperforming them to the tune of 2% so far. So bonds rallying a bit, stocks coming off the boil. Again, bonds tend to outperform in a weak economic environment. That's showing us, another red flag right here. And lastly, the staples to discretionary ratio. And as you can see, discretionary stocks are still outperforming staple stocks to the tune of about 10% this year. But look at this move off of the bottom. In fact, that was February 2nd. So I'm just going to look at how the ratio looks from February 2nd to current. As you can see from that point, we are talking substantial outperformance of consumer staples over consumer discretionary. And again, consumer staple stocks are the stocks of companies that produce the goods that we need to purchase to live, right? Consumer discretionary companies are the ones who provide the stuff we want to buy when we're feeling really good about our economy and about our personal financial circumstances. So when you get this outperformance, which we have not on the year because of that big January thrust, but since February 2nd, that's a red flag. Okay, so there's all I wanted to share with you today on the economy. Now we'll take a quick look at the stock market's technical setup. So this is the S&P 500 daily chart. You'll recall that we had this very classic bull flag pattern. And what you do is you take the flagpole, you attach it to the flag, and that gives you your upside target, literally right to the peak and where the market began to roll over. Now I drew this dotted line here because you could argue that we were setting up for yet another flag, right? If we continue to move up here and flag from there, that's going to get us right up to the August of last year high. Now, over the last few days, I've taken in 3 different technical analysts' views of the market, and 2 of the 3 are actually bullish, and both of them talked about this 4,300 level right up in here. And I can see where they're coming from. By the way, both of them are actually longer-term bearish. They just believe that the bear market low is probably a third quarter affair, and one was just willing to commit to before the end of the year. Now, I said in I think the last technical update that the next few weeks, 2 months that the second quarter was going to be very interesting to me. Because at least short term right now, while I don't have huge conviction, I would be in the bear camp. So the other one of the three I took in and I are pretty much on the same page. So, technicals are always in the eye of the beholder. But as you recall, the last several presentations I've made, I have said that the bulls definitely have something to work with here. You've got a MACD buy signal, you've got a good upward sloping RSI, you broke out of some levels here, and you're above the 50-day moving average and the 20 and the 200. You've come back here, you may test that and bounce. I get it. Real bullish technicians also believe the bear market is over. As I said, the three I listened to today, all of us are on the same page with regard to the bear market not being over. It's just we diverge in terms of what we think is going to happen in the short term. So what I see here is I see the makings of a high, but with momentum not being able to catch up. And those are kind of your classic bearish divergences. There's your uptrend, and you can see there, if this continues to move in that direction, you're going to have your rising wedge pattern, which against bearish divergences, as I've shown you over and over again for the last couple of years easily, tends to be pretty high odds that the market's about to roll over. If the bear market is over and the bull market has begun, we don't have technical evidence of that, but if we were to break firmly above here with some momentum, we'd have to start singing that tune, at least technically. Whether or not we'll agree on a fundamental basis, of course, remains to be seen. But typically the two will ultimately come together. And right now we still see bearish enough technicals with what we think is a notably bearish overall macro or general conditions setup. When we drill down to the 60-day, 60-minute chart, these patterns work on all time frames. So there's your rising wedge, right? There is your bearish divergence forming just ahead of the top on both of these, very overbought in here. You had your breakout, you came back, and this is what I was saying, we could test this and come bouncing. Right now it's just right there, right on the screws. So we'll see over the next week or so. I think the bulls are also noticing April seasonality, which tends to be very bullish for the market as well. Remember, it's sell in May and go away is the old saying, not sell in April, because April tends to be a pretty good month for the market. So I think that's impacting how people think about things as well. And I get it. These things can become self-fulfilling prophecies. Short-term traders who are looking to position themselves based on, say, the shorter to intermediate term trends, my guess is they're having kind of a rough go of it right here. The trend following strategies are, I'm certain, having an exceedingly rough go of it right here after having a pretty good run here the last year or two. So I don't think it's an easy market to trade. I do think it's I don't want to say easy, but I do think there are some obvious longer term macro opportunities in the global market across asset classes, not just stocks, that really excite us once we get through what's left of this bear market, and we don't think we're quite through there yet. We think that it could come sooner than later, perhaps even in the second or the third quarter. Other analysts believe that it's a later in the year, later third quarter, fourth quarter affair, if it's going to happen at all. Listen to BCA's economists, some of them are in the 2024 timeframe in terms of recession and consequently the bottoms of the bear market. So timeframes are all over the place. Quick look at the NASDAQ. We'll just look at the daily chart. One of the analysts who I listen to, I have a tremendous amount of respect for, is pretty bullish on tech and on the NASDAQ and expects to bounce off of this level. You can see where we successfully tested this area right here and bounced off of that. And we're literally just hugging the uptrend line here. Now, the way I look at the world, and this is just a very classic rising wedge pattern against very negative divergences, nearly overbought. You can see when we've had these patterns here, right? Rising wedge pattern, overbought, rolling over here on the MACD. Pretty big declines here in the NASDAQ. Here you can say we had a high, and you can see the bearish divergences there. Right, we came back, so we had a marginal high there, and then boom, rolled over for several percentage point decline. And then again, it works the other way, right? You came here, you had a bullish divergence, you got a buy signal, you got a really nice move, And the NASDAQ only to roll over once again here, but to not really see much of a fall. Pretty much saved it right there on the 200-day moving average. So again, I absolutely understand why you've got upward sloping moving averages well above there, testing resistance, could be off to the races, absolutely unequivocally could be. It wouldn't necessarily surprise me, right? Because people I respect think that's going to happen, and that would take us up here to get back here to test this high. And I'd probably back up the truck short if I were a trader up in here, unless something fundamentally changes that would make us bullish on the way here. And of course, that's always potentially on the cards as well. Okay, wanted to just touch base on sentiment. I said in the last video that we're starting to see some of the sentiment things we look at concern us a bit in terms of the near-term outlook for the market. So what we've done right here is charted the bull sentiment and bear sentiment as recorded each week by the American Association of Individual Investors. This is a widely watched, very popular sentiment indicator. And I've taken us back here to the beginning of the bear market. This is where the market peaked at an all-time high. And so again, the green is bullishness, the red is bearishness. So we actually had a positive bull-bear spread where the bulls were very optimistic right there at the peak. Now that's a contrarian indicator is what I'm getting at here, right? And then what I pointed to here was every time bullish sentiment moved above 30, so there's your peak there, right? And so we had that initial sell-off. People, market began to bounce back, and bullishness came back, bearishness declined. People were really optimistic just in time for the market to roll over quite notably, right? We had this level in here where we had it coming down. We didn't get the positive spread out of it, but we had bull sentiment above 30, right? Bearish sentiment coming down, and then we peaked. We had a little bit of a rally, peaked again there. Then we had a nice move last June through August, and sure enough, there's bullishness peaking right there, bearishness coming down to meet it, and then we rolled over to that October. So far, the lows of the bear market. Pessimism reigned. You can see the red line going up in terms of bearishness, green line coming down. We came out of that, got a rally. And by the way, so this is contrarianly bullish, right? When we have these peaks in bearish sentiment, right? In theory, lots of people, have moved to cash and are afraid, and then suddenly the market turns on them, and then they're afraid they're going to miss the boat, so they start rushing in. Here they're afraid they got out of over their skis, the market begins to roll over, and they get out of the market, and so forth. So this is where this contrarian thinking comes from. And then you can see here we came right back, bounced above here, just ahead, a few months ahead of the peak here, rolled over again, tried to come back. This area in here, we barely above 30. Not much action in there, but then when we really moved up there again and we actually had a positive spread, that's where the market peaked right at the end of January to bottom in March on really low bullish sentiment, pretty high bearish sentiment. And so here's my point, folks. Here's where we are as of last week, right? Bullish sentiment coming back, bearish sentiment coming down, kind of a precarious looking spot based on how this market's been trading during the bear market so far. Another one I wanted to throw in there that we don't have a chart on. This is from Investor Intelligence, and this is from their investment advisor survey. So this is as of this last week. The bulls jumped to 48.6% from 40.8%. So the advisors are getting bullish here. And just below 40% before that, we noted that a dip in their number, the bulls number, often signaled a trading opportunity. The bulls now equal their end of January peak. And that's end of January this year, which is this area right in here, which was the most since 2021. So the most bullish reading since before the bear market. Bulls nearing 50% are suggestive of a trading top. But in a bull market, they could certainly end up higher, and of course they can. But again, we're still, in our view, we're still technically in a bear market, at least with regard to the S&P 500. So again, something else to be thinking about from a contrarian standpoint is that the bulls are getting a little too bullish right here, perhaps. based on where these things tend to top out. Now, in closing, I want to offer up an opposite look and just express how this ain't easy stuff when you look at all the things that we look at. This is the net positioning among non-commercial traders in S&P 500 futures contracts. That is hugely bearish. So net short interest, by the way, this chart doesn't go that far back. That takes us back to a 2011 low, and that had been around the whole European debt crisis period. So this more comports with kind of how we're leaning, technically speaking, but I fully recognize that if we're wrong and these shorts, are inspired to cover, well, that can provide some serious because remember, a shorted security or options or futures contract is one that's been borrowed that has to be paid back. It's a bet, though, that they're going to be able to buy it back and deliver it to the lender at a much lower price and pocket the difference. And there's unlimited upside to the price. Therefore, there's unlimited downside risk. So make no mistake, when you see the market pop, or any market pop, or any stock, or what have you, remember my explanations of the whole GameStop phenomenon a while back. Heavily shorted securities can scream higher if the market moves higher against all those short positions. So I showed you bullish sentiment among individual investors and investment advisors that would suggest this market may be getting a little out over its skis, and maybe along with our view of what the technical picture looks like right now, we will get some weakness here going forward in the very near term. If we don't, and instead we get a push to the upside, which would be the bullish look at those charts that I've showed you here the last few weeks, and what I just suggested a couple of technicians who I have a lot of respect for are expecting, well, this is going to really give that some upside oomph and really make their case here in the near term. I'll leave it there, folks. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.